Welcome to the Opening Bell Report.
All right, let's dive in. Today, we're looking at an investment analysis of DataVault AI, or ticker DVLT. This is a microcap that's just put up just a wild number, a 147% revenue surge.
Yeah.
It's causing a huge technical breakout.
Yeah.
But, the devil is always in the details, especially when it comes to cash burn.
It is. It's a classic high-risk, high-reward setup. But I want to jump straight into the first major issue I found, which is how this explosive growth is actually framed in the report.
Right, you're talking about the comparison section?
Yeah.
I have to admit, when I looked at the chart in the analysis, it's visually very striking.
It is.
They put the growth bars right next to each other, Palantir at 70% and DataVault's at, almost 148.
Yeah.
So at a glance, if I'm an investor, DataVault looks like the obvious winner. I mean, why wouldn't you highlight that you're just crushing the industry leader?
That's the marketing brain talking, and it's very effective marketing, but it's dangerous analysis.
Okay.
The report leans so heavily on this comparison between DataVault and Palantir to sell the whole bullish story, but the comparison, it just lacks the necessary scale context to be useful.
But isn't Palantir sort of the gold standard? If I'm writing about an AI data firm, don't I have to compare it to the leader to show the potential? It feels like that's just standard practice.
Benchmarking is fine, but you have to benchmark apples to apples, or at least, apples to other fruit of the same size. Comparing the percentage growth of a microcap stock with, 2.9 million in revenue, comparing that directly to a mega cap like Palantir creates a really significant false equivalency.
Right.
I mean, the math is technically correct. 147 is bigger than 70, but it implies a similar stability, a similar market validation, and that's just misleading.
I see what you mean. It's a lot easier to double your money if you start with $10 than if you have 10 billion.
Exactly. It's the law of small numbers. I mean, think of it like a lemonade stand versus Starbucks.
Okay.
A lemonade stand sells 10 cups one day and 20 the next. They've just hit 100% growth. If Starbucks grows 5%, they've added hundreds of millions in revenue. So when the report puts those percentages side by side with no qualification, it's basically borrowing Palantir's reputation to hide DataVault's risk. It tricks the reader.
That's a really good point. It makes the microcap seem safer, more established than it is. So, okay, if I'm the analyst, how do I show that the company is moving fast without falling into that trap? I don't want to just, delete the comparison and lose all the excitement.
No, you don't have to delete it, but you do have to strengthen it by qualifying what's called the base effect. You need to give a risk-adjusted comparison, not this direct face-off.
So practically, instead of just saying DVLT is growing twice as fast as Palantir, what should the report actually say?
Well, for one, the report should calculate the absolute dollar growth. Just show the reality of it. Show the reader that Palantir added hundreds of millions in new contracts, while DataVault added just over 1 million. That grounds the 147% number in reality. It tells the reader, yes, we're growing fast, but we are a speedboat next to an aircraft carrier.
I like that analogy. Speedboats can turn faster, but they capsize a lot easier.
Right.
So what about the peer group? If Palantir is the aircraft carrier, should we be comparing DataVault to other speedboats?
Precisely. A really concrete example for improvement would be to add a section comparing DVLT to other microcap AI stocks. Similar market caps, maybe in the $10 to $50 million range. Like a pump and dump cycle. That's the data an investor actually needs.
That makes total sense. It adds transparency. Okay, and what about the phrasing for the Palantir comparison itself? Because I still think the analyst wants to keep that big name in there for, the SEO.
You can keep it, but just qualify it. I'd suggest something like this. While Palantir's 70% growth represents billions in established contract value, DVLT's 147% represents early-stage traction that is statistically easier to achieve but harder to sustain. It keeps the excitement. It says the traction's real, but it adds that necessary professional nuance.
Yeah, that definitely adds a layer of credibility. And that idea of credibility, it leads us right into the next problem. Because even if we accept the growth rate and we contextualize it, we still have to ask, where did that money actually come from?
Right. The report chalks this huge jump up to a pivot toward Web 3.0 data monetization.
Which sounds great.
It sounds incredible. It's full of buzzwords. It's trendy. But the report gives you zero granular breakdown of where that revenue actually originated.
I noticed that. The analysis claims the pivot is working just based on the top-line number, that 2.9 million. But I don't see a breakdown. But, cash is cash, right? Does it really matter where it came from as long as it hit the bank?
Oh, it matters immensely. In fact, it's the difference between a stock worth 50 cents and a stock worth $5.
Wow.
The analysis says the pivot is a success, but it doesn't clarify if the revenue is recurring software licensing, one-time data sales, or, and this is the huge risk, the liquidation of old hardware assets.
Ah, I see. So if they're just selling off old servers to boost the top line, that's not exactly Web 3.0 data monetization.
Exactly. It's like a bakery claiming their revenue doubled. But when you look closer, it turns out they didn't sell twice as many croissants. They just sold their oven.
Right.
That's not growth, that's liquidation. And you don't pay a premium valuation for a bakery that's selling its equipment. You pay a premium for one that's selling more bread.
That's a fantastic way to put it. So without knowing the quality of the revenue, this whole data asset narrative and the stock price that comes with it is just speculative.
Completely. If $1 million of that revenue came from a one-off gig or selling hard drives, the stock isn't worth a 20 times revenue multiple. It's worth maybe 1 or 2 times.
So the suggestion here is to dig deeper, go into the income statement, and validate this Web 3.0 story with some real proof. We need to look under the hood.
Yes, we need to verify that the money is actually coming from the new business model.
Okay, but let me play devil's advocate for a second. What if the company hasn't released that breakdown? You know, small caps can be pretty opaque with their reporting.
That's true.
If I'm the analyst, I can't just invent data I don't have. So how do I address this without just killing the whole report?
You have to be honest about it. The author should request, or at least highlight the need for a breakdown, specifically, revenue split, X% hardware versus Y% data services.
Uh-huh.
If that data is in the 10Q, it needs to be in this report. If it's not public, then you have to explicitly flag that as a blind spot in your analysis.
So you lean into the uncertainty.
Yes, don't just gloss over it. You could add a sentence like, the report claims the pivot is gaining traction. To prove this, we need to see that the $1.7 million year-over-year increase specifically originated from the new blockchain data division rather than legacy contracts.
That turns a weakness into a sophisticated observation. It tells the reader, I know what to look for, and I'm telling you it's missing, so be careful. It actually builds more trust than just blindly cheering the revenue jump.
Precisely. And it protects the analyst's reputation if it turns out the revenue is low quality.
Okay, let's shift to the valuation. This is where the rubber really meets the road. The report has this really bullish $4 price target based on price-to-sales expansion. But at the same time, it acknowledges this severe cash crunch.
This is where I struggled the most with the logic. It presents a $4 price target while in the same breath acknowledging a severe cash burn, but it fails to mathematically connect those two opposing forces.
I read that section. The bull case of $4 and the bear case of dilution risk are treated like they're in separate silos. It's like, here's the good news and here's the bad news, but they don't seem to have anything to do with each other.
They're in completely different rooms. The report argues the stock could hit $4 based on current metrics. But then it admits the company only has $1.68 million in cash against a $10 million burn rate.
Which means they have to raise money immediately, like yesterday.
Right. They have about 2 months of runway, so a capital raise isn't a possibility, it's a certainty. And if they issue new shares to survive, the share count goes up. It's basic supply and demand.
And that lowers the price target.
It has to. It mathematically lowers the price target per share, yet the $4 figure just stays there, static.
Hold on, let's pause there. I want to make sure everyone follows this. Why does issuing new shares automatically lower the price target? Can you walk us through the math for someone who hasn't built a valuation model before?
Sure. Imagine the entire company is a pizza cut into 4 slices. Each slice is worth $1, so the company is worth $4.
Okay.
Now the company needs money, so they cut the pizza into 8 slices instead of 4 to sell the new pieces. The company itself hasn't changed. It's still the same pizza, but now your single slice is half the size. It's only worth 50 cents now.
And that makes it crystal clear. So the weakness here is that the price target completely ignores the fact that the pizza's about to be sliced up.
Exactly. The logic in the report is basically saying, this slice is worth $4. Also, we are about to slice the pizza into tiny pieces. Those two things can't exist in a vacuum. The target price must reflect the new slice size.
So the suggestion is to synthesize that bare reality of the financials into the bull price target, create what you'd call a dilution-adjusted price target.
Yes, don't just list the risk, do the math on the risk.
What does that look like in practice for this specific report? Can we run a quick scenario?
Let's do it. The report needs a scenario model. For example, it could say, If DVLT raises $10 million at 50 cents a share to fund operations for a year, the outstanding share count increases by 20 million shares.
Okay.
Under this new share count, a 15 times price-to-sales multiple results in a price target of $2.50, not $4.
Wow, that brings the target down by almost 40%. That's incredibly valuable information for a reader. It shows the real cost of survival.
It does. And you change the narrative from the target is $4 to the target is $4, assuming no dilution. However, with a secondary offering likely, the adjusted fair value is closer to X.
It connects the dots between the balance sheet and the price target. I love it.
Yeah.
Okay, final point. Let's look at the conclusion and actionable setup. The report advises buying a breakout above 70 cents, based on technicals, but the justification is this long-term data asset on blockchain thesis.
This is a classic case of identity crisis. The analysis is oscillating between short-term technical trading signals and long-term venture capital theses without distinguishing the strategy for each type of person reading it.
I actually liked that part at first because it gave a clear entry point. Buy at 70 cents. It's simple. But you're saying the reasoning behind that entry point is muddled.
It completely confuses the exit strategy. A trader buys the breakout at 70 cents to sell at the gap fill at $1. They don't care about blockchain or Web 3.0.
Right.
They care about volume and momentum. A fundamental investor, though, is buying for some sports league partnership that's mentioned deep in the report, which might take 2 years to even happen. Merging them creates a messy, muddled setup.
Because if I'm that long-term investor, buying a technical breakout at 70 cents might be a terrible entry, especially if that dilution we just talked about happens next week.
Exactly. Imagine you're the investor. You buy the breakout at 70 cents because the chart looks like a rocket. 2 days later, the company announces a massive stock offering at 50 cents to raise cash.
The stock crashes.
And you, the investor, are now holding the bag.
Bag holder, the scariest words in investing.
Right, but the trader would have sold at $1 and been out before the news ever hit. The report gives bad advice to the investor by using trader logic.
So the suggestion is to bifurcate the conclusion, split it into 2 distinct lanes, one for the trader and one for the speculator or investor.
Yes, split the audience. Don't try to serve everyone the same burger.
Give us the concrete layout. How should that conclusion actually look on the page?
Create 2 clear headers. Under a header like For the Trader, you focus strictly on the 70-cent entry and the $1 exit, based purely on volume, spike, gap fill. Tell them to ignore the data asset stuff because it won't matter in a 3-day trade.
And for the investor?
Under For the Investor, suggest they ignore the 70-cent breakout level completely. Their focus should be on the cash burn runway. The entry signal for them might be something like post-dilution stabilization, not technical breakout.
That way, you aren't telling a long-term holder to buy the top of a short-term spike. That's a really crucial distinction. It makes sure the advice is actually relevant to the person reading it.
It just respects that different market participants have different goals. The current report mashes them together, and you get a strategy that's optimal for no one.
Excellent. This has been a very, very productive session. We've covered a lot of ground on this data vault analysis.
We have. It's a report with great raw data. That 147% jump is real. The volatility is exciting. But the report just needs to connect the dots better to be truly actionable.
So to recap for our listener, first, ground those comparative growth metrics in reality. Don't compare a lemonade stand to a beverage giant without adjusting for scale.
Right. Use absolute numbers or a relevant peer group.
Second, validate the specific sources of that new revenue. We need to know if the bakery is selling bread or if it's selling the oven.
Don't let the Web 3.0 buzzword hide what's really happening.
Third, integrate the math of dilution directly into the price target. You can't have a $4 target and a $10 million cash burn without showing how the fundraising hits the share price.
Do the pizza math. And finally, separate the trading strategy from the investment thesis. Don't give day trading signals to long-term investors.
Unless you want them holding the bag.
Precisely. I do want to offer a final encouraging thought here. The financial data in this report, the burn rates, the revenue figures, the technical levels, it's high quality. The research has been done. It's just about framing it so the logic holds up under real scrutiny. Absolutely. And I would love to invite the listener to resubmit this report once those valuation models are adjusted for dilution. I think seeing a dilution-adjusted model would be incredibly compelling.
Yeah.
It would likely make this a must-read analysis for anyone following the AI space.
We'd love to see it. That's all for this critique. Keep analyzing, keep questioning the numbers, and we'll see you next time.
Don't forget to like, share, and subscribe for more.